Hey everyone, welcome back to another edition of Super Prime UK with your Super Prime MJ Group valuers, myself, Rob Cohen.
Myself, James Wild.
Hope you're well, everyone. The summer is here, the sun is out, and the skies are blue. The temperature has finally increased, and we can enjoy the good weather, the holiday season, in terms of the bank holidays and Easter, etc., all over and done with now. And we can get back on track to some really good hard work over the next few months before the summer holidays come around. Have you been, James?
Yeah, really good, thanks, Rob. How about yourself?
Really, really, really good. Football season's over. Highs and lows, celebrations, commiserations, possible treble from Man City. How do you see it all?
Well, yeah, no, congratulations, Man City. 1 out of 3 down, isn't it? Obviously, you got the FA Cup on Saturday and then the Champions League final thereafter. Favourites going to both, of course, as well. So we'll see what happens there. Interesting last day of the season as well. I'm just going to focus on the Liverpool-Southampton game, actually. A very unusual happening. I don't know if any of you guys do many bets or accumulators, but Paddy Power often they pay out if your team goes 2 goals up. So obviously Liverpool 2-0 up, Southampton get back into it 4-2. So both teams 2-0 up and it ends 4-4. So they paid out on either team winning and the draw. So a real life arbitrage for anyone that bet on that game with that bookie.
Love that one. I can't believe that will happen again soon. Big shout out to the minnows out there. Great promotion for Leighton Orient and back to the Premier League for a local team of mine, Luton Town. Where are we with the data and the intel? Everyone's waiting. What's happening in the market, James?
Yeah, thanks, Rob. So obviously we've had sort of news this morning, slightly more negative from a economic perspective. But in terms of our live data, just going to run through that. Does that differ somewhat from what's being reported off the last data sets, which I have sort of a 1, 2, 3 month lag, Rob. So new instructions this week, 379, and if we go back to the following 2 weeks, we've got 376 and 345. So fairly good flow of properties coming to the market there. Sales, we spoke a couple of weeks ago, Rob, about them just tipping over the 100 mark and sort of lagging behind where we were for previous months closing out 2022. Sales this week 136, and if we go back for the last 2 weeks, 145 and 123. So the data there, Rob, has recovered somewhat and fairly healthy under offers as well, 204 and 256 the last 2 weeks. So I think that shows a strong pipeline to the last 3 weeks of data, which we've got on a live basis in the London residential market.
Yeah, speaking to a lot of agents, they are busy, lots of valuations, property coming on the market. Slowly but surely, we should see those numbers improve. Nothing dramatic, but incrementals as we move through the summer.
In terms of some of the data, Rob, that's come out of the Bank of England just today, actually, it shows that households have reduced their overall mortgage debt by £1.4 billion for the month of April, which is the highest net repayment since records began in 1993, apart from the 1 month during the COVID pandemic. So just talk us through that, Rob, in terms of what's happened last month, because from our perspective, that particular month, as we cast back to that March-April period, we were sort of reasonably sort of quiet in terms of what we saw happening in the market.
Yep. I think that's the live data and results of what we were seeing. Very little new lending taking place, a lot of repayments taking place on the back of maybe mortgages expiring, people not wanting to pay the higher rates that they're now looking or having to pay upon expiry. And so banks on a net basis received more funding on net repayments than lending taking place, which is something that's extreme and very, very, very rarely happens and would have been on nominal occasions over the last 2 or 3 decades.
Yeah, thanks, Rob. Just for an analytical point on that, obviously, I think the last certainly 6 to 9 months, a lot of those people's mortgages whereby they've expired from their 2-year or 5-year fix, they've actually moved on to their either variable rate a tracker, possibly a fixed tracker, slightly more expensive. But in terms of the overall mortgage debt reducing, Rob, is that sort of a reactive trend from what we've seen as so many people moving on to these variable and tracker mortgages?
Absolutely. People are just not willing to leverage or spend or repay at those levels. And thus the market is saying, we're not going to move, we're not going to borrow until the indicators and economic policy goes in a different direction. And that is the holding position where we are at the moment. The data is so clear, especially on this net mortgage borrowing release today. And it is going to take 6 to 9 months until economic policy and interest rates move in the right direction for new lending to take place and for the market to move forward in the direction that most people would be looking for.
Thanks, Rob. I mean, I think it's a crucial time, actually. The next Monetary Policy Committee meeting is going to be the first time where there's going to be a lot more pressure to keep the interest rates at the same level rather than this continuous rise we've had it in the base rate. So we're going to have to wait and see what happens there. The predictions were that we would remain at 4.5%, and that would be the peak. However, a lot of analysts are rebasing where they're at now in terms of what the peak will be, and a lot are saying it's going to, possibly breach that 5% mark, Rob.
Yeah, so analysts have realigned 5.5%. The position earlier on the year would have been comfortably 4.5 at tops. Things can change quickly. The scene across the water in Europe is inflation is coming in massively. It's really under control. Definitely believe that the UK will follow suit. And once the Bank of England, the monetary policy, are comfortable with that, that will be the moment for the interest rates to start coming back in. So I do agree, James, it does look like there will be another increase, whether that's a quarter or 2 lots of quarters to take us up to 5, or just one more quarter and holding position more likely. That will happen. At the same time, I'm very confident that inflation is definitely moving in the right direction, as we discussed in our previous show. And come Q4 of this year, Q1 of next year, interest rates will start moving in the right direction, although that perception is a longer position than initially thought.
Yeah, I mean, some positivity, Rob, in terms of the inflation has come back down now to 8.7. There were some early indicators were going to be 8.2. It wasn't quite as optimistic as some of the sort of commentators, speculators were saying, but at least we're back now into the single digit inflation, and hopefully that really has now peaked and is going to continue to drop off and come in.
I believe so, James.
Just lastly, in terms of the mortgage approvals data, which we've seen, these have reduced for April 48,700, which is come in from 51,500 the month before of March. So we've just seen, in terms of that, possibly the bottom of the market being that April 2023, where the data is pointing us so far. And we look back at the gross mortgage lending of 17 billion in April. That was 25% lower than the average of the past 6 months. And Rob, I've already said the last 6 months since the mini budget and Liz Truss has been a sort of a downward trending market. So I think it just highlights how far below some of the market averages April was in terms of the mortgage approvals and also the gross lending and borrowing.
Yeah, it's a real indicator that people are clearly deciding that mortgage approvals, lending is a low, and that's really clear, everything we've discussed in today's show. I think it's really important that everyone understands that a year and a half ago, we were at 100,000 plus for those approvals. Now we're below 50% of that level. And that's going to hover around that because it's not going to improve whilst interest rates are going up and mortgage rates are going up. It's not going to allow for mortgage approvals to go up and for people to have the sentiment and positivity to go out there and either refinance or buy properties. That position is going to hover and stay until economic indicators improve, and that's where we are in the market. But we will come out on the other side for sure, hopefully sooner rather than later. And like we've discussed today, James, there are some indicators that already small increments are being seen. It's just going to be a slow burner for 2023 until we get that positive news of interest rates coming back in.
Yeah, just an analytical point on that actually, Rob. We've seen obviously interest rates going up, and obviously the savings account savings rates have in turn gone up. There's sort of the instant access savers rates, which are now extremely competitive rates. A lot of people, maybe if they've got spare cash, they're putting it into these savings accounts rather than putting it into property at this sort of immediate time, with interest rates being high. Obviously the market having poor sentiment at the moment, and I think that there are those people sort of hovering, circling in the market that maybe will have taken advantage of the higher savings rates, and maybe will be just biding their time to re-enter the market, possibly in the summer or autumn, hopefully when we get this bounce coming out of the lull we've seen in the last 6 months in the market.
Absolutely. Final point for today, I've mentioned it previously, I'm going to say it again, spoken with a lot of the private banks we work with in the last week or two. They are finding it challenging. Why? Because Mr. and Mrs. ultra high net worth is buying in cash. A lot of those prime, super prime deals, over 50% now are cash deals. Why would you borrow when the rates are so high? Cash deals taking place, doesn't go through lending, and the data and intel that we're giving you today further supports that and confirms that that's where we are at the moment. And until those indicators, until the interest rate position comes back, mortgage lending is going to be difficult. Thanks, everyone. Great to be back, James, and we will see you all again soon.
Thanks very much, Rob. Thanks very much, everyone.